All right, thanks for being orderly and getting back here on time. We're moving perfectly on time. I love it. And I promise this is the last time you're going to see me on this stage. Okay. Yep, please, everybody come in, take your seats. We're going to get started. This is the famous equity panel, everyone's favorite topic, talking about raising money, talking about investing money, and where are the opportunities today, and so on. So without further ado, let's just go ahead and give some introductions and backgrounds.
Yeah, good morning. JC Clemens, Flagship Capital Partners. We're a real estate investment fund based out of Houston. We've done over $500 million in kind of lower middle market investing, both on the private credit and LP equity side. Currently, we're investing out of a $150 million discretionary fund that we've raised, putting out equity checks, $3 to $12 million per deal currently. Idea being that in each fund, we do 10 to 20 deals all over the United States, primarily in value-add multifamily.
Hi, everyone. Is this working? Testing, 1 million, 2 million. Okay, good. Hi, I'm Ella.
It's just kind of low.
Kind of low, but you can hear me, right? Okay, perfect. Hi, I'm Ella. I manage a family office in real estate in New York. The family has built over 38 million square feet of real estate over the past 30 years. In the US, they started with condo development in New York and now expanding to more the finance side of business. We're always looking at all asset type across the US, but specifically focus on residentials.
I'm Jeffrey Friedman, CEO of Tower 5 Real Estate Group. We're owner, operators, and investors. We're founded on family office principles. I like to think I approach the business multifaceted. My background is I came into the business on the LP side, then went through a finance program, and then worked on the management side for over 6 years. So we like to say that we like to view any investment or any deal that we're going to potentially GP or LP in for really from an operational perspective and the financial aspects of it.
Good morning. My name is Chris Cordes. I'm with PPR Capital Management. We're based in Philadelphia, and we're primarily a equity raise company, and we deploy about 65% of our raise into NPLs, or non-performing loans. And I run our multifamily asset class, and we've gotten to that about 3 years ago, and we have about 25% of our overall portfolio in that as well. We are about $1 billion AUM right now, and we're about approaching $300 million in AUM for just our multifamily alone. So hoping to keep that momentum going.
So earlier I mentioned that the last couple of years have been a changing time. It's been a difficult one with interest rates and opportunities and the dynamics there. So starting with JC, how have you kept yourself busy in 23 and now heading into 24? What are the types of opportunities that look attractive to Flagship today?
Yeah, it's been a super weird time, as everybody knows. So we were super active when nobody else was, kind of towards the end of last year and the first half of this year. So we invested in 6 deals, really from January 15th until I think we closed our last LP equity investment in June. And so we really wanted to try and catch that window where really nobody was doing anything. We were trying to buy deals on, 6, 6.5, 7 caps, Midwest, Southeast, and the financing, depending on when you were locking rate, was low 5s. And so there's pretty good delta there between going in cap rate and where we were fixing the 5-year loans. And so we were busy putting out the tail end of our last fund during that period, and then we just started raising money. And so really from June until now, we've been out in the market raising equity primarily from our high net worth individual base, really not any institutions. And it's been tough. And so really, I guess for us in the past year, it was trying to put out as much money as we could when the yields were there, when there really wasn't a lot of traffic, not a lot of people on the bid sheet. Everybody was saying, don't do it. So we did it. And then after that, we used that really as kind of the momentum to go out there and start raising our new fund. And we had our first close on our new fund about 45 days ago. And so now we are currently in the market, starting to see some things really start to move in the right direction. We've got 3 deals that are close to term sheet right now and hope to close anywhere from 3 to 6 deals before the end of the year.
And what makes those deals unique to where, in spite of the headwinds, you're able to make sense of it? Is it because you're writing a minority check? Is it because it's a tertiary market? What is unique?
Yes. So one deal that we're looking at that I think is a good data point for everybody is a deal that's in Charlotte. It's on the East End. Carlisle's the seller on it, and they're buying it for like 230, 240 a door, which feels pretty good. Going in cap rate on a 2020, I think it's 2021 vintage deal is like a 5.8 cap. And we were playing around with treasuries and kind of locked it right at a sub 5% rate on a 5-year Freddie deal. So new vintage deal, and that equity check for that transaction I think was like 17 million. And this group is a very institutional group out of Dallas that has a ton of institutional partners. They went to the institutions and it was a total goose egg. And so they had to go and raise the money from Dallas Country Club, and they were able to get to I think like 10 to 12 million, and they needed another 6. And so they called us, and we told them that it wasn't going to be on the terms that they raised the 10 to 12 for. And we're getting close on that deal. So I think that's a good example of somebody who historically has had institutional money that thought it was going to be a no-brainer with a positive leverage, new vintage deal in a great market in the Southeast, and just totally went cold just from macro issues. And so that was a minority LP check where we got control. And so that was one example. And then another one that we were looking at was a tertiary market deal in Tulsa that was north of a 6.5 cap, same financing, and the goal is that that's going to be a good cash yield going in at kind of like a 6.5, 7% cash on cash going in. And then if rates do nothing over the next 2 to 3 years, it'll be a low double-digit return. And if rates move at all, it could end up being a good investment. So really kind of looking tertiary markets and special situations is what we kind of focus on.
So Ella, perfect timing. We lost the mics.
Oh, okay.
So you've been really busy with preferred equity, which I would say is a way to kind of pivot in this environment to find value. So can you share more about that?
Yeah, sure. So really, I think the best opportunity for us over the past year is the pref and med space, especially between 3 to 8 millions, because you have project with cost overruns, increased interest rate, or the sponsor just couldn't raise enough equity on time, or the 2 guys before us on the debt panel just couldn't lend you more money. So that's when we come in and provide that crucial funding for the project to go smoothly and create values for all parties. And also, investors like those high yield fixed income debt product, because you're not just selling them a hopeful IRR at year 3 or year 5. They like that cash up front. So you're really creating product with equity-like return with debt-like risk, and they really liked it. However, every deal carries its risk, so you have to make sure the project is not significantly over budget or delayed, or something else might happen in the future where you would just throw more money down the drain. So you just gotta be very careful when you're coming in. Yeah. But that market has been treating us very well. Yeah.
And just, I'm curious, do you think those opportunities are going to go away and this is only a window in time?
I hope not. But depending on how the rest of this year unfolds, if the interest rate is coming down steadily and the banks continue to maintain pretty strict lending requirements, I do see there's still opportunity for the pref and med space, but also sectors like hospitality and some office properties. We see a lot of opportunities for us to step in or get involved, because I've noticed banks have been just passing on hospitality deals without even looking at it. And a lot of them actually make a lot of sense. So that's where we see value that we can bring to our investors. Yeah, and also the triple net market, I think, is being pretty good this year with relatively high cap rates. So we like that. We always focus on multifamily and student housing, especially with affordable component. The more affordable, the better, actually. And that philosophy kind of led us to looking at the mobile home park sector, which requires to do a lot more due diligence. If Rob is throwing this event next year, I'm gonna keep everyone updated with how that's going. Yeah.
Very nice. Go ahead, Jeff.
So I would say we look at every deal, whether we're coming in on the GP side or the LP side, really two approaches. Of course, we run our IRR and our exit projections, but having done this for a long time, we're very, very price per pound, very basic, price per door. Reality is, I think everybody in this room has seen the past 2 years, the cap rate fluctuations has been tremendous. And I think ultimately, if you look at the buyers who bought well in terms of a basis, and again, everybody could debate what is considered a good basis, right? We don't necessarily say a good basis because you're buying 20% less than it was 3 years ago. But in terms of a correlation between your rents, your expenses, and where you're coming in, and so for us, that's really has been a very big approach. So it's really yield on cost cap rate and yield on cost price per unit. The reality is none of us could predict the future. So if you're coming in at a good enough basis and you're coming out of the gate kicking off enough of a cash on cash yield, then everything really becomes gravy. And I think a lot of the equity that's in the market right now, and you're probably seeing that as well, is they're not IRR driven, they're not terminal cap rate driven, they're what's my cash on cash year one? If they're a little more patient, it's what's my cash on cash year 2 and 3. They don't want to hear that we're kicking off 4% out of the gate, but we have a great exit based on certain assumptions, and therefore it's a 25 IRR. I think that whole story went out the window. We were always a buyer like that. So I would say, we're very much back at the table in terms of when we're sitting with brokers and such. We can get deals done because we have the ability to be a little more patient. The flip side to that is we don't have the cash on cash necessarily, but we're getting in a good enough basis. We'll be patient because we think, we're buying a good asset in terms of that. And the same thing when we're investing. We're looking at same thing. What is the basis and what are the market fundamentals? One last piece here. I think people, especially unsophisticated equity, everybody looks at, oh, wow, I got a 6 cap here, a 6 cap here. This, I'm getting another point on cash on cash. The reality is no 2 6 caps are created alike. Every market's different. I think it's very, very important before anybody comes in on the GP side or the LP side, understand the market you're going into, understand local politics, understand the rent growth, understand the taxes, understand local legislation. And I think those pieces people are seeing a lot the past 2 years, and people are doing a broader due diligence, if you will, into the deals. And if you find a good pocket, like you said, some of the tertiary markets are great. We've done well. If you know how to pick out main in a good tertiary market, a good pocket, and a lot of equity is not going after that, especially non-institutional equity, you can do really, really well if you know those pockets. So I think there are good opportunities both in the primary markets and really main in the tertiary markets.
And Chris, obviously, you got to go last, so you got to think of something new.
Actually, we're very counter to how you were looking at things. We are actually very IRR driven, so we look at all of our multifamily deals. It's got to be about 20% minimum. And it's actually we're finding a lot of luck in that. With that strategy, not a lot of market deals, but honestly a lot of loan assumptions. That's been huge for us, especially because we also try to keep our deals on a shorter term. So we like to at least be like about 3 years. And that's been very beneficial. We've wrapped up, I think we'll have done 3 in the last 12 months and hope to do another one by the end of the year in the loan assumption range. But we also look at some very tax advantageous with affordable piece too. So there's, as Lone Star knows really well, the PFC and HFC structures have been, can be very lucrative, and that's something that we are investing in currently in Austin and looking to do another deal by the end of the year as well. And honestly, getting back into markets that we've already had repeated success. So we'd like to work with other groups and have more presence in some of these markets that I see us, doing more business in.
So staying with you, Chris, in this environment, are you finding it easier to invest due to lower competition, where sponsors like in JC's example, they have less options to go to? And, how are you winning deals when it comes to competing against other equity groups?
It's actually been very relationship based. Most groups, come to us. We've been really lucky to build up a network of sponsors over the last 12 months that, I honestly have so many deals in my inbox. It's hard to get through them all. It's a great problem to have. So it's really structuring the waterfall. We try to be main equity. We have to be a GP as well, just for from internal structures. So I have not found it. It's more competing with our internal portfolio management team, in the sense that we also have a very significant NPL deployment. So it's really, is a liquidity available for me to do X amount in multifamily? If it is, then we're good to go.
we'll go in reverse order now. So Jeff, for you, what in this environment is making it easier to invest, and then, for example, like less competition, but what is still making it harder to move forward?
I think the easier part is trying to go into the institutional space. Reality is for us, as a group, 4 or 5 years ago, I mean, the brokers have time, they pick up the phone because they knew we were active last cycle, so they knew we might hit this point, so they were friends with us, so to speak. But there's no question, the past 18 months to 24 months, you're coming in and you could close the deal. It's all about certainty of execution. So I think, we were able to come in, we bought a deal, institutional grade asset 6 months ago. It was a pure function of institutions not being at the table. So I think right now the sweet spot is really, I would say, the B plus A minus space. Yep. We try to stay away, I'm not going to say always, but we're always careful with the A plus space because we don't know where rents are going to go. We never like to be the top of the market. We like to be one tier below that. So we're finding opportunities in that space, especially we're starting to see merchant builders and such that need to exit. So I think we thought there'd be more opportunity on that front, but I think we're going to start to see a lot of people, a lot of these developers that bought time, they're just going to want to exit. So I think that's really the next opportunity.
And Ella, I know you're very careful right now and cautious on common equity. What are the reasons for that caution in this environment?
Right. So I think this environment does present some opportunities for equity investment because most investors are, sidelined or more cautious. But I don't think there's lower competition. There are probably lower competition in certain sectors, maybe some properties, but they have lower competition for a reason. Maybe it's too risky with high vacancy, or too complex with zoning or policy changes, or just larger asset like this office, buildings in Wall Street. They just require significant capital that many of us simply do not have the capacity to pursue, or the market, the asset class, or the location is simply too uncertain. But for good products, for good markets, I don't see lower competition. Everyone's bidding on it. We lost a bid in a student housing project, and we found out the other person paid 10% more than us. So, it's not like you're going to see a Birkin bag ever go on sale on Madison Avenue. You probably have to butter up the sale just to get it full price. For those of people who don't understand, you're probably single and you need to ask the married guy that's sitting next to you. That will make your wife very happy. So in this environment, we're definitely being very cautious and extremely careful with good fundamentals just to make sure it has good values there. Yeah, so very careful.
You want to touch on this, or do you want to?
Yeah, no, I mean, I think this is it's gotten back to old school real estate. I mean, relationships. I mean, I haven't gotten a deal done in the past 18 months. When the market's super efficient and everybody's got deals and money, cold call somebody, get a deal done. I mean, none of that happens anymore. You can't even get a lender that you did a couple loans with back on the phone unless you have a good relationship with them. So, I mean, I've gotten, the deals that I've gotten done are with people that I've struck out with for the past 5 or 6 years that we're finally landing on something. And those relationships, I mean, it sounds so cheesy, but where we've won deals recently is not by beating people up. It's actually by giving a little bit. So if we have to offer another $500,000 on a $20 million asset, it's marginal at the end of the day. And I think that's where a lot of people are missing a lot of good deals, is that they're getting, hamstrung by $50,000 here, $200,000 there. I mean, we had a deal in Lexington to where the guy was like, "Can we move it another $1 million to win it?" And we had tons of room. We said, "Just do it." I mean, it was a $22 million acquisition. We're going to hopefully sell it for 30 and another $1 million at the end of the day if the number still makes sense. I mean, I think it's all going to kind of come out in the wash. And so for us, we've told everybody when we're looking at these deals, if you're going to go up to somebody who owns a property and say, "Hey, man, I'm willing to buy it at the loan amount," that conversation's probably going to be really short, right? But if you go up to them and say, "Hey, I can give you a loan amount plus 5%, plus 10%, and your numbers still work," I think there's a pretty high likelihood that you're going to be able to win that deal, because they're going to be able to tell their investors, "Hey, this isn't a total strikeout." And just the mental difference between telling your investors, "I lost every penny," to, "Hey, I got you something back," there's a huge difference between those two. And so pretty much all the deals that we did, we said, go in and offer, above the loan amount, where the broker was saying it's probably worth the loan amount or below. And we've got those deals, they're ripping cash right now, and it looks like it's going to be a good transaction. So we're doing we're being cautious in our underwriting, but we're not getting stuck on marginal dollars because we think that in 5 years from now, the world's going to look a lot different. And if there's cushion, we'd rather aggregate AUM right now as opposed to just looking at an Excel model and talking ourselves out of it.
So basically, the strategy is pay more.
Yeah, I mean, the only you talk to anybody. I was talking to our friends from Omaha last night. You know, we were looking at the same deals, and they were like, "Man, I'm pissed you got it," and I was like, "I'm kind of pissed I overpaid for it." You know, I mean, it's the same story, right? I mean, if you won the deal, you paid more than everybody else. You know, that could be a good thing or a bad thing.
That's how it goes. So
Yeah.
aside from paying more, what creative strategies are there to actually make it work, right? Because if the market's looking at it as, oh, loan basis, how do you pay more and then structure things on the back end to either protect yourself as the equity or to kind of coach up the sponsor and, hey, okay, well, if we're going to pay more, we need to have the debt look a certain way, or are you behind the scenes helping negotiate with the lender on a loan modification?
Yeah, I mean, it's getting in well with the brokers and just telling them what a real number is. I mean, there's just so much nonsense that's going on the bid sheets right now to where, you know, people are taking stuff out at 17, the seller's a real seller at 18, and the broker's out there just trying to get some stuff on paper for them. And so we are very good about telling all of our broker friends all across the country, you know, every acronym, you know, possible and every single major metro, we just tell them a real number. And they know that we're the equity behind it and that we can close. And I cannot tell you how many times 3, 4, 6, 9, 12 months later, they've come back to us and said, hey, are you still relatively close to that number we talked about? And the sellers have had something happen, you know, death in the family, 20 other properties go south. Now they're willing to move on this one, trying to figure out which babies to save. And I mean, it really, I think, again, it just goes down to relationships, like not burning any bridges, being truthful, transparent with brokers, owners, sellers, and just saying, hey, here's our number. Like, cannot tell you how many times people have said, that's the most ridiculous offer I've ever seen. I can't believe y'all even put that on paper. And that's what it ends up transacting at, you know? And so you just kind of have to have a short memory, be nice to everybody, know that some people are going through some hard times right now. And so if you get a bad email or a bad phone call back, like, don't sweat it. I mean, at the end of the day, just do the right thing, put a number down. If it works, great. If not, just keep going. It's a numbers game.
So Ella, you mentioned a deal that you got outbid on, and which
Right.
was surprising to you. What about a deal that you walked away from? You wanted to do it, but in the end, you decided to walk away.
Yeah. So I think a recent one is a multifamily deal in Brooklyn. We have worked with the sponsor before. It has really strong cash flow. However, this time they just decided to do this project in a blind pool special situation fund. And we just couldn't get comfortable with that structure because we can't commit to a fund when we only know one of the 10 projects and have no idea or control to the other 9. We just simply can't do that. And then I think a second one I remember recently is another multifamily deal in Manhattan. It has really good basis. It was kind of like a private distressed sell, but we couldn't get comfortable with the team. I think for the scale of their stories are inconsistent. Their legal documents are definitely inconsistent. And for the scale of the portfolio, I think having a formal office setup seemed pretty necessary, but they don't have one. So it seemed like they are quite capable and successful raising from family and friends, but they're not quite at the level yet to raise from family office and institutions. Yeah, so that we had to walk away.
That's a good story. Okay, continue to go down, just talking about.
So to JC's point, I think it's critical in today's environment. You got to be very upfront with the brokerage community. And at the end of the day, sometimes it hurts, but you got to do it. We closed on a deal Q4 of last year. Okay, so if you look at Treasuries Q3, Q4, they moved around 70, 75 pips. It was very volatile. So we put a deal under contract when the 5-year Treasury was 4. Okay, we were going to rate lock. It was 472. So we all know what the 72 bips does to the deal. So we told the brokers, listen, we have a good idea. We're going to push this deal out 60 days, but we're going to go ahead and we're going to release some deposit money to you. We want to show we're real at the table. And at the end of the day, Treasuries came in. You know, Nate Lowy did a good job. He brought in some spreads for us, and we were able to close basically on proceeds that we wanted to get. And at the end of the day, the sellers called us up after and said, Jeff, it was a pleasure working with you guys. You told us what you wanted to do. You kept your end of your word, and we worked together. We worked through it. So people sometimes get very nervous, have the conversation, speak to the broker, just have the conversation. Just work it through. There's somebody on the other side. They want to get the deal done. And, and it doesn't necessarily have to be a whole fight, right? People sometimes call the broker with both arms up, like put your arms, put them down and just, man to man, try to figure out a deal.
We did a deal during that exact same timeline, called the broker, said, hey, we're going to close it on a bridge loan and we're going to do it agency in 60 days. Yeah. Called Uncle Saul, got a really rough loan for 30 days and paid it off, and were able to get better proceeds way better than we would have initially done. And the seller initially thought, oh, these guys are not going to do agency financing. They're flaking the whole deal. And we just had we flew up here, met with them in person, open kimono, talked to him about it, said, hey, we got the funding. We brought our bridge lender that was going to come in for 30 to 60 days and told him everything. And then we just refied that deal out, and the rate is so much better than we initially underwrote. And it cost us $300,000 to have that bridge loan for 45 days and just a deal cost, right? And we're going to make up for it on the 50 basis points we made up on the rates coming in on the agency loan over 5 years times 4. And so that's obviously not a traditional method, but most sellers would have jumped off, said we're not doing it, but we ended up just flying up here and having a meeting with them, got it done. They got paid. We're in a good spot. Again, old school real estate.
And they would love to sell to you again, and the
For sure.
brokers will love to work with you again.
Everybody got paid.
So, yeah.
Broker got paid twice, for doing the loan, so he was really happy. But yeah, sorry to jump in. Funny timing.
Chris, you want to talk about a deal that you unfortunately had to walk away from recently?
Yeah, so I will never commit to anything and then, walk away. That's just not how our process is. We generally try to be very apparent and transparent with our sponsor groups. However, there was a deal that I was pushing pretty hard with our portfolio management team. It was a great another loan assumption deal based in Chicago. We were going to be getting it for $3 million less than the seller purchased it prior. 10% year on year, or cash on cash year one. But a lot of the pushback I got from our group was that they didn't believe the rent growth. They didn't see that the business plan would be affected. So despite my pushing, I had to, eventually walk away, from that deal.
And just want to add on the creative part you asked earlier, that may be something that I can share with the room. So we're being creative with either being the pref, mezz, or senior B note, and we're willing to reduce check size just to make things work. But however, one thing I noticed recently, and actually it's been going on over the past 2 years, is really with COVID putting the world on pause and having this high interest environment rates in the US, a lot of international capital coming in. And they're looking to benefit from this safe and higher rates in the US. And especially, I've seen over the past 2 years, the EB5 capital has been exploded because of the policy changes, and also because a lot of sponsors are having difficult time raising equity domestically. So for those of you who probably don't follow, EB5 is a program that allow you to get permanent residency through a job-creating investment in the US. And a great example would be, I think, Long Island City, with all this developments going on, really creating that rental demand and bringing that rental demand back to New York from New Jersey. Another example would be Hudson Yard, that's built with EB5 money, but I won't speak too much about that. Yeah, because they're in a lawsuit, so.
If I may, for a moment. You mentioned before you're focused more on the debt side. My question to you, is that because you're getting equity level returns on the debt side?
Correct.
That's
Correct.
your motivation.
Yeah, in the pref and med space, and especially in development, because our background is from condo development, so we're willing to take more risk on those projects.
Yeah, we've got a private credit arm, and I do those deals all day, to where we're leveraging the senior and making a 16 on a 70% bridge loan, loan to cost type deal, and we're borrowing, 70% of that on the back end. It's a good place to be. It's just people seem to have amnesia as far as what bridge money cost, right? So like in 2017, I put out $200 million at 9%. And then rates went to 0. And everybody's like, oh, a bridge loan at 9%, you're hard money. Like, not really. If you look historically as to what bridge money is costing, so I think a lot.
2010, 12, we were putting out 25% plus.
For sure. And so I think that's the part that I think the market will cure itself over time, but everybody's having to come back to reality and what has to happen. Cap rates have to get higher, and so I think it's just part of the process. But I think that the bridge space will come back. Because, in theory, the best time to do a bridge loan is when everybody's saying don't do a bridge loan, right? Because I think there's a lot of people that are locking down 5, 7, 10-year financing right now that are going to get their face ripped off by yield maintenance when they want to sell it. And so I think a lot of people, we're doing a lot of 5-year deals and paying a lot up front to buy down the back end so we can get out of these loans.
Very good point. So let's talk about sponsorship. Ella made some good comments about not being comfortable with a sponsor. In today's environment, JC, is there anything new that you're thinking about when evaluating a sponsor when looking at a deal?
Yeah, I mean, I think a lot of people, especially on the investment side, have kind of learned a lot of lessons over the past 5 years as far as, where you're willing to take risk. And for us, taking risk on the sponsorship side was really never part of our MO, thank goodness. And so for us, it's really, we always say we'd much rather be in a bad deal with a good general partner than in a good deal with a bad general partner. Because we've been in some really good deals with some bad general partners and we've made zero money, and we've been in some really bad deals with good general partners that might have seemed bleak at a certain point in time, but at the end of the day, we worked together and collaboratively, we all made money on those deals. And so for us, it's making sure that the sponsor is net liquid in the deal, like they're putting their own money into it. So they're not putting in $500,000 and taking a $500,000 act fee. So having their own money in the deal. Interestingly, we look back at our entire portfolio. We've got 30 investments across the country right now, and we've had better performance on newer-ish operators than we have with larger operators. And after going through some kind of soul searching as to, why the data is showing that, is that, for the folks that we invested in that have 4 assets and they've got 90% of their net worth in those 4 deals, they tend to pay a little bit more attention to it, right? And the people that have 5,000 to 10,000 units, sure, they've got the machine, they're vertically integrated, they've got all this experience. But we've learned that you're just number 26 of 57. Right? And at the end of the day, they look at it smartly from a very objective perch. And so they just look at which deals are the ones that are going to make the most, and they give a lot of attention to those, and the other ones that they know are kind of lost, they kind of let go. And so we really are trying to find that happy medium between, we're not going to do somebody's first deal, but we really like that up-and-coming sponsor that's had a couple full cycle, doesn't have too large of a portfolio, has their own money in the deals, but are still small enough to where they actually focus and care going and moving on site, and really kind of being there. Because the one correlation that we were able to find in the 2023 year of asset management, the correlation to performance was how often the sponsor was on site. So we went through all this analysis, all these audits of everything that we looked at, and all the deals that were performing well, the sponsors were there every week, every other week. All the deals that were not performing well, we found out they were only going once every 3 weeks, once a quarter, that kind of stuff. But they hired the best property manager. They had the best GC, best leasing agents. None of it mattered. All that mattered was the sponsor being on site. And so really we're looking for people that kind of fit that perfect medium right there.
Chris, do you want to add anything on your guys' process of evaluating sponsors?
Yeah, a big screening process for us is really to make sure that the group is, vertically integrated. It's not a deal killer, but I really do think that helps, alleviate any potential miscommunication between, third-party property managers, and also, if they provide like a robust, reporting, monthly reporting on time. That's, really key for us to really know that the group is really on the ball. And additionally, just to echo earlier, definitely having skin in the game is really important too. We want to make sure this is a joint partnership, and not just us providing, the main check. So, and one last point too is, I really, especially with some of the groups, we do quite a bit of like robust CapEx programs. So if, internally, if someone has a pretty significant knowledge on construction, is always really helpful too, and not just relying on third-party GC.
So moving on, Jeff, do you want to talk about your fundraising process today? How has that changed from years past?
I would say it didn't really change much from us. We're a large tranche of our equity is family office equity, which is very powerful, especially in today's environment. People want to know you have skin in the game. So on any given deal, we could be coming in between 10 to 50% of the equity ourselves. So that's that. And then once we have that, we have relationships with people who want to come in. Digressing for a moment, but what you both mentioned earlier is that I think right now the whole business is operations. I think there was a lot of fancy spreadsheets, and I run on Red IQ, and we have 15 tabs, and we run it across. At the end of the day, I think your point of people going on site and your point of reporting, it all boils down to the same thing, operations. Do the principals or the people running the property really know what's going on day to day? And I think there's no question that every property right now needs some level of attention, or you have to be able to pivot a little bit from your business model. And if you're not tracking how many people are coming to your front door, what's your conversion rate, okay? Are you drawing from the right traffic, right? People say the market's softened. Okay, did you look at the data? Who are you bringing to your front door? Maybe you have to do something different. We had a property that we did a lease up. We were 55% occupied. We moved from 72% to 95% in 8 weeks. I took every single billboard in town. It cost me 50 grand. I was rebranding a property. People said it has a bad name. I hired one person to go to every county fair with a thing. It sounds basic, but the reality is you got to think out of the box. This was a bridge loan. I needed to exit the deal, and I needed to get somewhere fast. So the reality is that where we are right now in the marketplace, I think it's all about operations. So there's different components to that, but I think at the end of the day, you know, for us, any deal we're buying, we're making sure that we're operationally ready to take it down. We're set up for it. And any deal we're investing in, we're asking ourselves, are these operators capable to really execute their business model when things go wrong? When it goes right, it's great. Now, to answer your question in terms of equity, we're you know, for us, you know, thank God, we're staying the course. You know, being the fact that we've been in the business for 75 years plus, we have a lot of partners, a lot of investors, people want to do business with us. We have certain fundamentals, and you know that we don't change, and you know our investors appreciate that. I think the most important thing is, at the end of the day, something goes wrong, I'll pick up the phone, I send an email, something went wrong. You got to be a big boy. I sold a deal last year at a loss. Okay, I was 40% of the equity myself. The reality is, I call my investor, listen, it hurts. I think that's the best thing for the deal. I'm not going to go out for a capital call. We took a 20% loss on the deal, and you know it was a very high risk deal. So at the end of the day, to lose 20% on a very high risk deal is not bad. But you know sometimes you got to be a big boy, pick up the phone, and do what you have to do.
So JC, you've been more involved recently in fundraising conversations.
Yeah.
So what do those look like?
Yeah, so historically we're high net worth individuals that, you know, we have 20 to 40 partners per fund, you know, high net worth oil guys, insurance, bunch of real estate guys, interestingly, and gals. But, you know, that bucket is very interesting right now because we've raised $50 million in the past, call it 90 days from that group of individuals. And there's kind of two camps. There's one camp that people that have a ton of exposure and a bunch of deals that are getting capital called. And so they're kind of, you know, doing triage on some of their stuff. And then there's some other people that want to go head first right now. And so I think the overarching theme is pretty interesting. So in the family office world and the institutional world, they pride themselves on not investing in funds, which we're a fund, because they can skip the double fee, double promote, because they're so smart, they have these relationships, they can save their investors X amount, right? I have many friends at family offices and institutions that are losing all of their money on every real estate deal that they've done the past 24 months. Just point blank. Full write-downs, taking a total loss on it. These were people that probably should not have been investing direct without a consultant or an internal broker or somebody who knows real estate very well. And so we're seeing a shift, at least in some of the Texas family offices and smaller institutions, as to where they're saying, all right, can we pay flagship 1.5 points and some of the back end to do everything for us and make us look like geniuses to our family office? Yeah, and it helps, you know, you got to think of it kind of like an index fund. You know, we're going to be 20 deals, 2 are going to go bad, 2 are going to be grand slams, everything's going to fall in between the bell curve, and we're starting to get a lot of reception from the family office, institutional, RIA world, to where they're saying, hey, maybe we shouldn't put $15 million into one development deal in Katy. Maybe we should put $15 million into 15 different deals all over the Southeast, with the hope that at the end of the day, instead of making a 22, we make a 16, but there's a very low chance that we're going to lose all of our money. And so that's been a common theme kind of in the family office institutional world. It's been kind of an ego swallow for a lot of those people, and there's been a lot of, you know, we have to go in there and not saying I told you so, and kind of do it the right way. But high net worth, 2 camps, people doing triage on their portfolios, or people, we had one guy that usually puts in 500 grand at each of our fund, and he came in for 15 million in our most recent one. Just because he goes, I don't care what the headlines are. I don't care what's going on in the market. If people were buying these things at 120 a door and you're buying it for 80 a door, I'm all in. Mm-hmm. And he's done that for the past 60 years of his existence, and he's always made money. And as was said previously, a 40% discount today probably isn't a steal, but that's probably a good market rate purchase, with, you know, hopefully greener pastures in the future. And so, yeah, high net worth individuals, 2 camps, institutions, we're starting to see a little bit more of a shift into the fund investing, which is great for us, but it's a longer process getting them on board for sure.
Chris, you also manage a fund, so what does the fundraising conversation look like there?
Yeah, so we have a general fund. We have a great IR team that has gone out to our network. It's been a little slow this year. I think it finally caught up to us, but I think we're still really robust in all of our asset classes. Really trying to diversify. People really see us as an alternative, investment group. So. I don't do a lot of deal raising, so I just focus on the business development. But we're hoping to be at about 120 million raised this year, and I think we'll consider it a pretty successful year considering how slow everything's been.
So I appreciate the panel for being so open. There's some ups and some downs, and also the downs create opportunities. So sticking with that, for struggling investments in your portfolio, we can start again here with JC and then work our way down. For deals that are struggling, what are you and the sponsor doing to improve the situation? How has communication changed? What advice would you say generally there?
Yeah, so we were lucky because we're operators first, kind of like we used to operate 35,000 units before we got into the money business. And so we always say we're real estate guys that got into the money business, not money guys that got into the real estate business. And so we kind of saw the operations, delinquency, bad debt, on certain deals in our portfolio start to tick up pretty early on, and we go full psycho. It's literally calls every week, sitting there looking at cash balances, early conversations with lenders. Because we're a lender, we're very good at having those conversations with other lenders. It's funny, even the biggest and baddest in Wall Street operate the exact same. So it's having early conversations, transparent conversations with lenders where needed, doing loan mods where needed. We don't have a lot of that in our portfolio, but I think early communication with general partners, letting them know what the documents say is important. Because a lot of people just they just sign partnership documents. Very little negotiation or true understanding of what's going on there. And so it's not hey, we're going to throw you out. It's like, hey, if things get really bad, this is how this is going to look. And you'd be amazed how quickly people start to focus on their properties once you kind of remind them of, hey, we're not here to really sour this relationship, but we want to make sure that you understand the full situation here. And after that, it seems like everybody kind of puts their business hat on. Everybody starts picking up the phone a little bit faster. Everybody gets going. And at the end of the day, us as an LP, we're there to help them, not hurt them, right? People like to JV with us because we've been in the trenches many times. And so once you kind of get everybody back around the table, don't be shady, stop, full transparency. If it's really, really bad, tell us because we can help you get out of that situation. And so then we can go to bat for you. And we have a lot of conversations with, vendors, to where they're trying to collect X. And we say, why don't you propose saying Y, and kind of teaching people that may not have been in a operationally tight situation before and really kind of giving them some pointers. At the end of the day, it's a general partner's liability, their responsibility. But we get in early if we see things kind of turning the wrong way, and then we kind of put our general partner hat on ourselves and don't go in and move them out of the way or wipe them out or remove them. We just kind of get in the driver's seat and have them very close next to us to kind of say, hey, look at how we do this, and then you can take it from here. But getting in early, because if something's going from 95 to 91, it's going to go to 86 to 82. It's just a fact. The trends, it's very rare do things oscillate at the 92 to 95 for forever. So if you start seeing it turn, really look at bad debt delinquency, what's happening on the ground, and you're going to figure out what's causing that. And then figuring out how to fix that. If it's capital intensive or just, being on site or operationally intensive, then you can hop into that.
Ella, go ahead if you have something to share.
Yeah, so to JC's point, that's why we have expensive attorneys. People can be really unpredictable, especially in, difficult times. Back to the ideal sponsor, it's really those fundamental qualities of honest responsibility, professionalism, being exceptional at what they do, and always strive for better. I'm describing Rob here, if you notice. So it's really about a good relationship is putting that 200 pages of legal doc in the drawer and work things out. But if you're working with a sponsor lacks character and got all their monies back already from all sorts of fees, and you don't have no say or no power in how to get the project back on track, then all I can say is good luck. Like, so really read that, document carefully. Yeah, that's my advice. Yeah.
I always say you got to be prepared to put on your overalls. The reality is your staff is underpaid and overworked in this business. You look what a property manager makes, you look what a lead maintenance person makes. Comes the summertime, these guys have to switch, on a typical property, the amount of HVACs they have to change out on a week is insane. Which means that if you see something, inefficiencies in your property, you literally got to be ready to put on a pair of jeans, walk the property, walk with your maintenance guys, and I'll tell you, between me and my maintenance guys, I have multiple layers. But if I see reports and something's not good, I'm getting on a plane and I'm walking through and I show me your process. And I had a deal we bought in Georgia. I did a site visit and I saw units were sitting. And then next few weeks, printed availability reports. Something's wrong here. I got back on the plane. A week later, we replaced the whole entire staff. They were completely asleep at the wheel. Yeah. And the reality is I saw it because I was in unit G7 and literally it looked the same way. So I think it's important to realize that staff's underworked and you got to really be on top of it. And something's wrong, you got to be able to roll up your sleeves. The flip side to that is you have sometimes some exceptional people running your properties. And when you have that, we had a team on one property did a great job. I sent somebody from my office, my acquisition guy, because I couldn't get anybody else. He flew down to South Carolina, took everybody bowling in for dinner. It's small gestures. It's important. These people are hard, they're overworked, and you have to be ready to come in and see what's going wrong. And when they're doing it right, you got to compliment it. And you want them to go the extra mile. At the end of the day, these people you're giving them a $50 million asset to run with values that could fluctuate. We all know when you're going for financing, 2-3 bips of occupancy could be hundreds of thousands of dollars, if not millions, right? So you're entrusting them with a lot. So make sure that you have that relationship and an open line of communication, because when you need it, it's going to be critical that you have it.
And I'm just going to be kind of a repeat customer in this one because, it's really just, increasing the communication. We've had to adjust some weekly calls to every week and really making sure that we're having updated reporting, weekly reporting, that's really crucial. And also, even if for some occupancy issues, we really try to be more grassroots as far as marketing, going back to old school tactics that seeming are working, and even really being there for the current tenants. I think that's really important too, that they see that the operations team is there working with them. So whether if it's like a Spanish speaking group, that all the staff members, are bilingual, or, actually promoting resident events, even if there's not a lot of capital for it. I think it's really crucial that way you can keep, renewals and keep the occupancy growing that way.
Yeah, and to the other side of that too, if somebody's totally kicking ass, let them do it, right? We've had some people come up with some wild ideas for on-site stuff with, foam parties for the kids and popsicle trucks and all this kind of stuff. And my CEO, who's 77, is that's the dumbest thing I ever spend money on, but it's 99% full and they're sending us $200,000 a quarter.
Absolutely.
I'm like, dude, we don't care what you did in 1990. This is what's working today, And so we make a big point with general partners that are doing very well. I want to talk to them once a year and let them do their thing. I think that's really important too, is to not micromanage somebody who's doing a good job. And so that's when they're not doing a good job, there's always a chance to hop in and point to docs and be tough. But if somebody's doing a good job, we totally give them as much leash as they want. And you'd be surprised how many people want to come back and do deal 2, 3, 4, 5, 6 with us because they remember that we didn't have weekly leasing calls when it was 95% leased. You're doing a good job, we'll stay out of your way. So.
Okay, thank you very much to our panelists. We now go ahead. We now have plenty of time for Q&A, so please, someone kick us off. Doctor, can you and Mike out? Or, yeah.
I got a quick one.
Yeah.
So just JC real quick. You talked about yield maintenance and defeasance, and I want to hear kind of your perspective on 5-year debt, 7-year debt, 10-year debt versus shorter term. And just to kind of add a little context, we syndicate deals and have a lot of investors, and so I always think about it from the investor experience. And so given that you control most of the equity, it's a little different in the sense of I can see how defeasance is certainly a problem, but it usually comes up most when you do really well and sell a deal early. And so you get where I'm probably going.
Yeah. No, it's a great question because it's really tough to raise equity on a deal-by-deal basis if you say, hey, man, we got a smoking loan at 9%. I mean, it's tough to tell. What I would say is on those deals, if you have the ability to pick your more sophisticated investor group to come into those, because it's just a cost of capital conversation. It's just simple math. So if you're paying 9% for X and you've got a rate cap and it costs 250 grand, I mean, literally you can lay all this out. Your equity costs you 20%. Your debt, you can get more leverage, and with the cap cost, it's going to cost you 10%. And you just lay it out for them. And so I would wait for those deals. To your point, it's going to be hard to raise money on a syndication basis for a deal with a bridge loan on it. But if you have some people that have been in the industry a long time, I mean, defeasance could be millions and millions of dollars. Same thing with yield maintenance on the back end. And so there's some people that like the risk and some that don't. But you're exactly right. It's very hard to go out to a blind pool and tell everybody, hey guys, we got a great deal. We're taking a loan at 70% at 9%, and you're buying the deal on a 5 cap.
For sure. And that's like the front end. And what about the back end? Because that's the part that, like, when I got in the business, there was a lot of people that had gotten burned from 10-year loans, and I thought they were the geniuses because it was 10-year, what could go wrong? And then there's a lot of sob stories about them having to sell and pay those 7 figures. But from my perspective, I was like, yeah, but you never got a negative email from an investor being like, oh, this 2x could have been a 2.9x. You know what I'm saying? I'd like to hear perspective on that as well.
Yeah. So a good example is a deal that we did recently in Louisville. Guys bought a deal for $35K a unit, and there was just no qualification for an agency loan. And so what happened was we gave them $10 million, call it, and they drew down, I think, another $5 million from us over 13 months. They then refinanced with an agency, paid us off, paid all their equity back, and then locked rate for 10 years. And so I think it's really got to be specific to where the bridge loan needs to be likely a heavier rehab deal. If it's something to where you're just moving the needle marginally, it's probably not the right decision, right? Because if you don't move that needle marginally and the loan does something like this, then it doesn't make a lot of sense. But these guys, they didn't necessarily care what the interest rate was because they knew that they were going to be essentially transforming the property and putting $50K a door into it. And so at that point, they cared about the draw process and how quickly they could get those dollars funded because we keep it on our balance sheet. And so again, it's very situationally specific, but I think if it's a larger rehab deal, the bridge makes more sense because you're just not going to get agency dollars if you can get it at the right basis, right? And so there's got to be enough room there on those.
Thanks. Thanks so much.
Next question. Well,
Here, Hamill in the back.
Just one for Ella. So I'd like to hear more about your terms in your program. I'm trying to get a sense of, like, if I never want to call you or if we should talk, like, right after this.
Oh, you should call me for sure. It's 646. Yes. So pref and meds are expensive money for sure in the market, as everyone know. But those are really very crucial in uncertain environment like today. So I would say if you need that money for a year or two, and then you just need a little more time to raise that common equity to kind of secure that good deals, I think you should definitely call me. And we also do senior B notes, on some hospitality deals. I think that sector is being really good. And especially, I would just say really maintain that core relationship of that 5 to 10 investors who really believed you and who really have been through tough times with you. That will make the difference because you can have the most fancy technology, you can have the best brochure, best office, but in uncertain time, you can have 500 people on your investor list, but none of them will invest. So it will really pay off in the long term to take care of that core group of investor. And you take care of them, they take care of you.
Super helpful.
Yeah.
So I had a question, kind of military mind kind of thinking here. We always talk about how we always want to de-escalate. But the thing is, our enemies have a say in whether or not we go to war or not. They get a vote. How does the prospect of the war in the Middle East escalating and potentially something over in South China Sea coming to fruition, how do you think that's going to impact the treasury market and how Powell decides to go forward and then obviously trickle down to us?
Yeah, it's a great question. I mean, macroeconomic stuff is something that we talk about a lot because we have to deal with it on the investor side when we're answering these questions from people that have, everything that was going on in the Middle East with Israel. We had some GP pension funds that we were buying out of some deals, and so we had to have some real conversations with them. I think at the end of the day, if something really wild goes on from a macro perspective, it will be, not good for the broader economy, public equities, that kind of stuff in the United States. But I think that the government does a very good job of propping up housing, and so if there's something that's really scary that's going on, they're going to make sure that the home front is on their team. And a good way to keep the home front on the team is to keep rates low so that people can have cheaper rent and good housing. And so from, just to kind of get, since we're on the political train, with the election, we're kind of seeing it as kind of two different camps. And if it's in the middle of the road, that's kind of where we see it to be probably the roughest. So if it goes, one way and the economy crashes, then the only way that the government knows how to pull an economy out of a recession is to drop rates, and that's we're all going to make a fortune, right? The other extreme is if another person gets elected and just puts gasoline on the economy and it just explodes in a good way, could hurt us inflationary on the long term, but in the near term, renters are going to have a lot more money, the economy is going to be great, and so there could be a little lull, way out of the lull there. And so where we see the danger zone is something very mediocre, to where, the Fed really does nothing and keeps it kind of stable, and there's not the volatility, because volatility drives transactions either way. We're in the transaction business, and that's how we see it. So I think the two extremes are likely good for lower middle market real estate, because I think that's where most people are in here. But if it's something very mundane and in the middle, stagnation would not be very good for our industry, both on the treasury side or on the economy side, because then you're just going to have deals that are at 5 caps and you can finance them at 5. And that's a very stagnant zone for us to be in.
So Ella, I'm curious over here.
Oh, hi.
I'm curious if you were to provide $3 million in pref equity right now, what kind of terms would you be offering along with that? And is there any fees or anything like that that are included as well?
Right. So I'll speak on a broader kind of perspective. If you need more details, we'll talk later. But on a general sense, we actually come into the deal just as we were the common equity or the senior loan. You got to make sure your DSCR, your yield, everything check the box. And one thing we're very important and take a lot of time with is to underwrite the deal in the perspective of common equity. We have to make sure we come in to provide values, or not just draining those people out of their hard-earned money. If this deal is losing money, we're not going in. If we can actually make this deal a little better in a longer term, then we're coming in. And we work out the numbers right now in the market. I think it's anywhere between 13% to even 18% on some office, office convert to residential project. So it's really finding. Oh, I see this one. You're very surprised. It's really high, right? Yeah, I know. I was really surprised to learn that too. And then, yes, really finding that sweet spot for everyone to be comfortable with. Yeah.
I think 18% pref on office is cheap.
Oh, really?
Yeah, I do.
Okay.
I'll send you some office deals.
I'll speak with Colonel Allen about it. Yeah.
When you guys are vetting new operators, what do you guys like to see in the deal room that sort of stands out and shows they got their stuff organized and they're giving you enough information about who they are that you're not just going to get out of building that deep relationship with them?
Just normal information on the history, kind of your kill sheet over the years, I think is always super important. You've had some deals at a loss, kind of seeing we've been in this long enough to where if you have a bunch of deals like 07, 08, 09 and it's 10, 15, 20, 30% haircuts, we don't see that as necessarily a bad thing, because if you don't have any bad lender knocks on your credit, then you operated the right way. And so we're smart enough to kind of see that on the sheet and understand that you know what you're doing. And at the end of the day, we always tell people, tell us everything, because we're running a full FBI background check on you. So we're going to find everything. We do everything from social media to 25-year criminal history to credit. We have people that will find everything under the sun. And so just tell us. It's much better. I can't tell you how many deals we've killed when people didn't check the box on a foreclosure, and we found it, immediately done. Even if there's a story there, oh, my assistant did it, oh, I misunderstood it, we're done. So just check the box, give us the letter that you have prepared by your attorney on every other deal that you've ever done, and we'll talk about it. But if there's ever any sense of withholding something, then there's plenty of other people out there. We're done.
Chris, you wanted to?
I think also copies of financial reporting, and they can just be samples, but that's always helpful to see what's in there. That way we don't have to go through it, later once the deal transacts. That's always really helpful.
So I'm closing on a $15 million pref equity deal tomorrow. And it was not our first choice, of course, because I think what was difficult was the common equity tranche that followed that was really difficult to raise because they didn't want to sit behind another tier of capital. And so, but it made sense for the deal. And some of the new structures with different capital groups that we're speaking to now are providing some sort of hybrid between pref and equity, where they're trying to de-risk. And so they would want to come in with, say, 90% of the capital stack. And they want to stay in sort of as a pref and where they get priority payment of their total equity plus their pref return, but still have ups on the back end. So wanted to see if you guys are doing some interesting capital stack structures or just different strategies with some of your clients.
Right. So I think it will really depends on every deal, right? And by the way, good for you closing on that deal. I have never done that kind of creative like structure with that kind of like convertible like pref equity to come out to get the upsides or anything, because I think you have to be focused with your strategy. And that to me is something like, okay, I'm not very sure of how this deal will go. I want to protect my downside and also get some upside. To us, I think it's better to have that fixed income type of product to our investor. They understand, we understand, and we're willing to give the upside to the common equity because they have worked really hard. The GP has worked really hard for this deal. They have put the guarantee and everything. So we have done a lot of, just like very strict like pref and common. But that sounds interesting because the right now is really uncertain. So if that's that's a fit to your strategy, I think that's good. The incentives got to be aligned, Yeah.
Yeah, we've done a lot of really weird stuff. I think at the end of the day, what's going to kill a lot of that is all this side letter stuff that's coming up. And if you haven't talked to your attorney about that, do it as soon as you can, because a lot of that was typically done through side letters, And so they would be giving up X portion of the GP to this sliver of common, and it, in theory, wasn't going to impact the rest of the common equity because it was coming out of the GP bucket. Now with the new SEC compliance stuff and some things from the regulators, side letters are kind of essentially going away. And so there's going to be a lot more transparency in that. But one thing that we have done historically is kind of had like a return look back. So we had a deal once to where we were coming in, it was a riskier deal. They needed our money, quick close. And so we said, hey, at the end of the day, we're going to need to make a 20 on this deal. If you can get us there through us being common, sweet, we're good. If you can't, say we're at a 17.5 at the end of the deal, that 2.5 spread will be coming out of your GP promote. And if it doesn't come out of your GP promote, you're going to need to find it from somewhere. And so that's kind of a look back on an IRR basis to where, we said we're going to come in as a common, but at the end of the day, when all the dust settles and there's X money in X buckets, we need to get made whole to a 20. But if you do it and it's a 28 IRR, then we're just a common and, you never see any difference. So that's kind of a creative way to where it doesn't impact the other LPs in theory. And it comes out of the GP side to get us the return that we think is adequate to make up for the risk of the transaction.
Are you at a 20 right now, or is
the clock's still ticking on that deal, but I think that they're likely going to recap that transaction, and so through the recap, we're going to get our 20. So they're going to come in. They wanted to end up holding the deal for like long term within a family trust type operation, and so they're going to. We put $3.7 million in that deal, and so whenever they recap and refi and hold it long term, we're going to get made whole on our 20.
Is your threshold at 20% now?
No, we're a 15 net is kind of what we go to. So every deal that we put $5 million in a multi-deal, we need to make a 15 over 5 years. We're strictly IRR driven, no multiple, no cash on cash.
Okay, cool. I think we need to wrap up. So thank you again very much. Great panel.
Good job, Dave. Fun.